All right, team. Here we go. let's uh let's talk about my system, okay? So first, right off the bat, I use Thinkorswim, okay? I use Thinkorswim as my charting platform. So you have to have a computer, okay? Don't buy a laptop. Don't waste money on a laptop. You can do it on your phone, but you're not going to get the data that you can get on your computer. So the first thing you want to do is own a desktop, okay? And desktops are very, very cheap. You can buy one. You could probably buy it from some dude on Craigslist or the guys that repair computers for just $200. Very, very cheap. I mean, that's just one trade, literally. So invest into a computer, and you can buy a monitor with it. Monitors are also very cheap. You can buy them on OfferUp or what's the other one? Craigslist. Basically anywhere where they buy and sell stuff. Buy a cheap monitor there. You don't really need anything fancy. Just make sure it's above 25 inches. Above 25 inches really gives you this pristine look where you got enough space for the RSIs, the TTM squeeze, the volume. This is all data, you guys. This is all math, and you need this. Okay, this is very, very crucial, and I'm going to show you through everything. But the start is you're going to need a computer, all right? And it has to be a desktop because there are these charting platforms that look very different on the laptop. I do not prefer a laptop. I recently went on vacation and I bought a brand new laptop for it because my recent one just didn't get the job done. And I was like, what is this? It's terrible. It's so small. I can barely see my candles and let alone the detailed data that I want to track. So don't get a laptop. If you do get a laptop, I would say get a monitor with it. That actually works. If you have a laptop and you want to save money and not buy a desktop, just get a monitor with it, and have your screen basically open up on the monitor so that you're able to see this. I'm not sure if that entirely fixes it, but I'm pretty sure that does that does get the job done as an alternative. But I do encourage you to get a desktop and use the desktop for just 10 to 15 minutes, maybe 10 minutes per day, okay? You need it for 10 to 15 minutes per day to go through the list of the stocks that I'm going to show you, the scanner that I have that you can start with, and just let this be the norm for a year or two, and things are just going to pile in and compound and compound. Your understanding, the knowledge is going to compound. Your own approach and effectiveness is going to compound. Your style is going to greatly improve and expand. So all things are going to happen. All good things are going to happen through time. So you get a computer, okay, team. You get the desktop. You're going to download Thinkorswim or whatever platform that you use. TradingView is another great one that a lot of traders use. There's other traders out there that also use Webull charting, which I really, really like. There's traders out there that use E-Trade, but I've heard they're not really a fan of it. But if you're going to choose anything, go with exactly what I'm telling you here. Just download Thinkorswim, sign up for Schwab. It's free to sign up for their brokerage. And once you sign up with Schwab, they're going to allow you to download their Thinkorswim platform, and it's absolutely free. And yeah, you with just 3 clicks. With just 3 clicks, you're going to have everything that I have on my computer: the 200 SMA line, the 20 EMA, the candle views, those scripts right there. Whatever I have on my screen, you're going to have those exact things on your chart. Okay, and you can do that with a very, very easy click of. You can go to the pinned messages here if you're in the Discord and click on that link. Okay, so you'll copy this one. You'll copy that ToS script right there. Copy link, and you're gonna go back to your ToS chart. On the top right corner, click on setup, open shared items, and click Control plus V, or just paste it in there. Whatever buttons you use that pastes it in there. For me, it's CTRL plus V. And once I type that, I click preview, and this is what it shows, okay? Import item as body 2025 official setup. You're going to change it to yours, and you're going to put 2025 or 2026 setup, and you'll click import. When you do that, nothing happens, okay? But then when you go back up here to top right corner setup, and you click on your the one that you just imported onto there. So for me, that would be body 2025 official setup. It loads everything exactly like the way I have it. Okay, um, so if you're a thinkorswim trader and you are in my Discord, that is how you do it. Okay, now if you are not in Discord, and you are not in thinkorswim, you don't have thinkorswim yet, I want you to take notes. All right, I want you to take notes. So here's what you're going to add to your chart. This is my strategy. All right, for my indicators, I have the volume. So I have the volume average, the 50-day volume average. And the reason why this is crucial is because volume is very, very crucial when it comes to price action. It shows you if a certain move is backed by smart money, is getting an inflow, or it's getting an outflow. So it's very, very crucial that you do have volume. So my first indicator is volume. My second indicator is the TTM squeeze, the TTM trend. So the TTM squeeze, this is how I have it set up. The length is 20. I'm not sure what NLK means. NK 1.5, NBB 2.0, alert line 1.0. I'm not sure about these. This is the ones that I've really adjusted. I've adjusted the histogram, the volume composition, and the squeeze alert. So I've changed how I basically modified it to take out all the extra stuff that you're going to see once you add the TTM squeeze to your chart. But if you want to get it the same look that I have, whether you be on TradingView, Spider, whatever it may be, just make sure you have those data, okay? This is for the histogram. You can pause it and then come back. This is the volume composition. And this is the TTM squeeze right here. So you see on some of them I have the show plot on, but on histogram I have the show plot on, but I don't have it for the other two. So make sure you do keep that in mind, okay? And yeah, I use the TTM squeeze and I use the RSI. For my RSI, I have the oversold line at 30%. I have the overbought line at 70%. So for my indicators, I use the volume, I use the TTM squeeze, and I use the RSI. Do not add anything else, okay? Please, I want you to stick with this for at least a year and a half without having to change anything. Everything else to me, I feel like might be extra. Like some traders use the CCI and like a bunch of other data. I really don't think you need it. All you really need is the volume. I would say the TTM squeeze because we use that as a fuel indicator and also as a way to measure the swing highs, the swing lows, basically measuring the breadth of the market. And then we got the RSI that shows us what the internals are doing behind the price, which is also very, very crucial. So for my indicators, this is what I have. And for my chart, all you need is the hollow looking candles, okay? So you got the hollow candles, and if you would like, you can go ahead and take a screenshot of this right here, of the appearance, and if you would like to get the appearance just like how I have it, the same setup, you can go ahead and get that done by applying the same things that I have. But yeah, the type of candle chart is this one, okay? It's candles. So you can use bar, you can use candle trend, you can use Heikin-Ashi, line, area. There's all sorts of them, but I personally use candle. And the reason why I like this particular structure is because it gives me extra data points. I have 4 data points to work on each candle. It tells me the open of the day, the high of the day, the low of the day, and the close of the day. So each candle is giving me 4 data points right off the bat, and that to me is very important. I've messed with the other ones, but not really my thing. I love the candle. Like I said, it gives you great level of data, especially once you recognize which kind of candles are the ones that are backed by money, backed by smart money, and which candles are, let's say, this or that, and which candles are a sign of rejection, a sign of exhaustion. Very, very crucial. But yeah, so for the candles, for the charting, I use candles, okay? Just candles. And for my moving averages, these are the only 2 moving averages you need. Don't add anything extra, please. If you're a short-term trader, don't add the 7 EMA, don't add the 15 EMA, the 50 EMA, don't add any of that stuff. The reason why you don't want to add too much is because it messes with you psychologically. And I know traders that have it, and I see them in my chart getting sucked into that. And I'm like, my gosh, man, this is what I used to do back in 2021. I used to think, oh, they broke below the 7 they broke below the 7 EMA. Oh, okay, maybe this is a fake out. They're gonna go for the 20 EMA, and they break 20. Oh, maybe it's going towards the 50. This is where it will reverse, and it just goes on and goes on and goes on. That's too much. Keep it simple, okay? Keep it very, very simple. Simple and effective. Don't, if you add too many moving average lines and you're looking at the bigger time frames and such, it messes with your view. Don't add the 50, the 100, the blah, blah, blah. Keep it very simple. Add the 200 SMA line. So the 200 simple moving average line, 200 SMA, I use it as a home base, okay? I use that moving average as a trend home base. I use it to tell if we are in an uptrending market or if we're in a downtrending market, how far we are from the current home base of the uptrend market, how down we are from the downtrend market, how oversold we are. Do we need to come back down and test the home base one more time before we go for another decline? Or if we're in an uptrending market and we are very, very overbought, do we come back up? Well, this right here was the tariff war. So the tariff war itself, this is something for another day. This can be seen as a liquidity on the bigger time frame, okay, team? Which we will talk about. I will tell you what that means. This is actually really great to see in prolonged uptrending markets, because this resets the trend right here. But let's go to a stock. Let's go to Bank of America. Let's click on Bank of America. And you see Bank of America, right? We talked about the 200 SMA line being a home base moving average. So what does it mean to be a home base moving average? You get very overbought from it. You're not buying up here anymore. You're if anything, you're going to be selling. You're going to be selling your positions slowly, or however you like. You de-risk it, and then when you get close to the 20 EMA line, you get back in on that bullish engulfing, close to the moving averages where demand is overwhelming supply again, and you're going to go for another uptrend. All right, team? So this is how I use my 200 SMA line and my 20 EMA line. But specifically, the 200 SMA line, I use it as a home base moving average to tell how far we are from the given trend, how close we are to the given trend, and all of the good stuff, or whether we're in a downtrending market or whether we're in an uptrending market. So that's my 200 SMA line. All right, team? So far, so good? Now, the 20 EMA line. But, team, I know I haven't provided too much information on how to trade the 200 and the 20 EMA line. I have in other sessions. But for those of you that are watching, don't worry about finding out exactly what you need to do with them. For now, I just want you to add it to your chart. Add it to your chart. Make sure you have those two. You have the 200 SMA line, the 200 simple moving average line, and the 20 exponential moving average line. So far, so good, team. So the 200 SMA, the 20 EMA are my moving averages. Those are the only two moving averages that I have on my chart. I use the 200 SMA line to tell if the market is in an uptrend. Sorry, if the price is in an uptrend or a downtrend. And if that particular stock price is very, very overbought from the moving average, and it needs to correct its way to the 200 SMA line to attract demand again, or if we are very, very oversold from it and we need to come back up and test it. So in an uptrending market, now, like I said, this happened during the tariff war, and this behavior is quite normal for these kind of how do I say, for these kind of disturbances that happen on a global scale, as we saw with the global markets. I mean, we had $131 trillion or something, or was it like $34 trillion that was basically that was going wild because of the tariff wars. Now, let me show you an example of a downtrending market. If you guys remember, this is where we entered the downtrending market. And it was very clear that we had entered the downtrend at the time, because we started the 200 SMA line, the 200 SMA slope changed, and we got below the 20 EMA line. And as you can see, at that time, we were going down, right? So when you first reject the 20 EMA line and you go into a downtrending market below the 20 EMA line, you're moving in this way. You're going expansion, contraction to the 20 EMA line, expansion, contraction to the 20 EMA line, and so forth, okay? And now, what did I say about the 200 SMA line being a home-based moving average? What did I mean by that? If you're in a downtrending market and that particular stock is very, very, very oversold from the 200 SMA line, you're not gonna short down here, and instead, what you're going to do is you're gonna be patient for the stock price to come back up close to its moving averages again, have some sort of rejection as we see with that massive supply bar there, and then you start shorting that again, okay, team? Because then you've come back up to the home-based moving average, and now the trend is ready for another decline. You get what I mean? So in bear market conditions, if the bear market were to last longer, that's what you would see. You would see that continuation go on over and over and over. Now, for those of you that are in the learning process, you're going to say, but how am I going to know if the trend is going to come to an end? There's going to be signals, and as you learn more price action strategies, that's where this comes in. For example, when you see stocks are failing to make lower low structures, they're not going, you see this one right here had a lower low right here. This had a lower low. This had a lower low. But right here, you're seeing a change of structure, okay? First, you're seeing those higher highs come in, higher highs and higher lows. And finally, this is what changes the aspect of the trend. Right there, instead of us making that a bear flag situation where we have this bear flag, we go drop, we do the drop-based drop. Let me go back to the bear market there. When did we have the bear market? 2022. Oh, that's another bear market that we can take a look at. That's also perfect. But let's go to the 20. There we go. So as we can see, you're seeing these bear markets, you're seeing these bear flags, okay? In the downtrending markets, you're going to see these bear flags formulate where you do a drop-based drop, and there are occasions where you even come back up, you retest that supply zone, and then you go for another drop. And like I said, the more understanding you have over the market, the easier this gets. In downtrending markets, the market moves in a different way, and there's really nice ways to identify these kind of conditions. Well, to show you the characteristics, this is how downtrending markets move, okay? You got the lower highs, lower lows, lower highs, lower lows, lower highs. This happens only in downtrending markets. You never see that structure happening in an uptrending market. So it's very crucial. This is what basically changes the dynamics of the trend, changes the math behind the algo trading of the markets. So I want to show you something else too, a little bit more detailed that we practice all the time. Not practice, we trade all the time. So this right here is this is known as a drop-based drop. It's a smart money backtest short signal strategy at the supply zone in downtrending markets. You got a drop, and then you get a base formation, and you get another drop. After you get that drop, you come back down inside of the demand zone, and this is where your supply zone is. You look for a reversal candle, and you trade it back down for a lower low to come. That's exactly what happens here. You have that supply zone there. Let me just make it a little better. So you got that supply zone there, and you're coming back inside of that supply zone, and then you are going for another sell-off right at that bearish breakdown below the 20 EMA line. You're going for another expansion away from the 20 EMA line. So whatever I was showing you in the last hour with the trend being up, now we're looking at it with the same understanding, the same strategy, but with the trend down, okay? Very, very simple. Now, like I said, when the trends get way, 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 way too overbought, where you go from 461 all the way down to 361, you're going to see what is known as a relief rally, okay? A relief rally gets us close back to the 200 SMA line home base, and this is why I use it as a trend indicator. You see right there, it rejected, printed the supply bar, and sent the trend right back down for another lower low to come. Very interesting, right, team? So that's how the trend moves, and then you start to see things like that, right? You start to see the 200 SMA line sloping flat, which tells you this could be a potential accumulation, and you also begin to see the trend forming the higher low structures. So let's go back here and take a look at why this particular structure is so important. When you place a higher low structure right here. So this is what we're looking at. You see, this was an equal low, okay? I know it went down a little bit lower. That candle went down a little bit lower, and I want you guys to also keep this in mind. Take it as a learning here. When you see a lower low like that, and then a massive, massive demand bar regaining that that support, this is usually bullish. Okay, that's usually known as a liquidity grab and very, very bullish. So when you see that, you can draw your line, and this would technically be this sort of equal lows. Okay, instead of seeing a new lower low, you're seeing equal lows, and finally you're breaking a bull structure. So a bull structure would honestly be somewhere around here. I would consider that to be a bull structure, which we will talk about shortly. But what I want you to pay attention to is once we get that rebound, you don't have to do nothing during that time, by the way. You don't really have to do much. You don't got to be pressured into trading that move. You possibly could enter off of that demand and buy stocks. But when you come around here, the trend is still bearish. So nothing is really changing in regards to the downtrend. But this is where things start to change. When you get that pullback and you are instead placing a higher low structure, which is only found in downtrending markets, this changes the dynamics of the trend. This followed by that move up where you're finally placing a higher high above that prior high fully changes everything. This changes the trend from going into a downtrend to now an uptrend, and this is where that higher highs and higher lows come in, and it just keeps on going. So this is how a trend changes. I wanted to share that so you guys also have some understanding on that and you're not fully confused. But that is how trends change. All right, team? But most importantly, team, I wanted to show you how markets behave in downtrends too using the 200 SMA line, and why I use the 200 SMA line as a trend indicator or as a trend. You guys see that, right, team? You see how first we were rejecting the 200 SMA line, and then finally we are building it. We are now holding it as support, and we are extending away from it. And during the extension, you can see once they get above the 20 EMA line, they consolidate, they break the resistances, and then they do those massive expansion moves. That's what I want you to also identify on your own. I want you to first start off with adding the 200 SMA and the 20 EMA line on your chart, and then all the other advanced knowledge that I have shared here is going to come to you, and it'll fill that void itself. As long as you're pushing forward, your mind itself subconsciously will compound that understanding and connect it for you. So that's what I mean by I use the 200 SMA line as a trend, and you can see as a home base for the trend. You can see it comes back down here, resets the trend, and takes us on another rally. Absolutely beautiful, right? Holds support at the 200 SMA line and goes right back up. It's okay sometimes for us to get below it, okay? What's really crucial is us regaining it. This is when you're not going to enter immediately at the test of the 200 SMA line. Keep that in mind, okay, team? If you see those candles, you're not entering on those candles. You may enter size on that candle. That'll be your starting entry right there. And as we come back up right here, this is your reinforced adding and basically knowing that, hey, this is it. We came back up, held the 200 SMA line, collected liquidity off of that long-term bullish channel that we have been inside of, the same way that we held it there, the same way that we held it in the past. We tested it. We came right back up. Demand is strong. I'm expecting another rally towards that level of resistance. Now, Rob, one of our team, I had a phone call with him on Friday, and he asked me, I struggle with identifying where my profit target is going to be. Here's how you identify your profit targets, okay? It's very, very simple. You look at the resistance levels up ahead. So if you enter right here, your first very small target is going to be that structure break. Now, obviously, you're going to expect that structure to get broken because this should break it. If it doesn't break it, this will absolutely put the stock in a bear market because it'll go below the 200 SMA line and start moving in the lower lows, lower highs, lower lows, and just will continue to decline. So it's very crucial that bulls do need to put an end to that downtrend that was in motion for the corrective wave. Once they put an end to the corrective wave, you got that impulsive wave basically extending higher. So that's what I mean. You would obviously expect that resistance level to be broken. So that really shouldn't be your first your profit target. Your profit targets are likely going to be right here. This is your first profit target at that level of resistance. Second profit target at the high of that level of resistance. And if you are like us, where you you farm your contracts, let's say you buy long-term call option leaps around here and around here for the very long term, then when we come up here and you see that digestion taking place, you're going to continue to hold your positions higher because you still have over a year and a half left on your options contract, and you're getting closer and closer to your strike price, which means delta is also absolutely working in your favor. And now when they print those massive demand bars, you are going to print, man, print. This is why I also buy contracts for the long term. I look at it as of I'm farming my contract for the future, and I'm doing it in a way where I'm investing for the future. Here's what I mean. If I buy a short-term 6-month or 5-month, 3-month call option, by the time we go from here to here, I'm going to be very nervous of a sell-off coming in, because if it goes down, not only do I lose the gains that I have got, but given the option mechanics, I'm also going to pay interest on the options contract, which is the theta aspect. So I'm going to pay theta, which will probably take 50%, 60% of your options premium, and that's horrible. Opposed to you buying a lot more time, which adds durability, and on top of durability, when you're up here at that level of resistance, you can say, you know what? I see this very bullish. The market's holding up very well. Nvidia's holding so well. Apple's holding so well. All these stocks are looking so great. I think we're going to continue to advance higher on this bull market. So if you have that thought process and your contract still has a year and a half left, oh man, you're gonna bank, because now you have a closer delta. You have an increasing delta. You have a lot of time, and the trend continues to go in your favor, but with more momentum and more general public involvement, which means FOMO and all kinds of absurdities coming in with it. But yeah, that's honestly how I look at price action. So now that we talked about how I use the 200 SMA line, let's talk about how I use the 20 EMA line. Now, the 20 EMA line, I use it as a momentum gouge, okay? As a momentum gouge. What does that mean? When we are away from the 20 EMA line, you see right here, this is considered away. Every time you see an expansion, right? I do not get in right here. I do not get in right here. I do not get in right here. I do not get in right there. Okay, team? Sorry about that. I enter when we go down a little bit and we're close to the 20 EMA line. We let the moving averages catch up. We create a digestion there, and then we print the demand candle. Once we print the demand candle, I'm expecting bulls to get another expansion in. Now, here's how I take it. Let's say in the prior week, right, I was trading the technology sector to ride that move, because the technology sector was showing up on my scanner. So if I show you Apple, you see how Apple's showing up on my scanner right here, team? So I'm looking at Apple, right? And I'm like, oh my God, Apple looks so bullish. It's above its 20 EMA line. It looks like it's going to get another expansion move on Monday and Tuesday session towards that gap fill at 247, okay? So if I see that, I'm going to, I would trade that, okay? I would trade that going into Monday and Tuesday session. And then let's say that move plays out. Let's say Apple does its move, and now Apple's trading away from the 20 EMA line, so I don't touch it. I wait for another corrective wave. So now, when this move happens right here and we get away from the 20 EMA line, I'm looking at other sectors during that digestion that takes place. I'm looking at other sectors to see what other sectors and industries are showing up on my scanner within the S&P 500 or whatever it may be in that case. And I'm going to trade, so let me just put my sectors here. There we go. Not sure why it went away. But then what I'm doing, team, is I'm trading other sectors and other industries that are showing up on my scanner to continue to go higher with the overall market. You get what I mean? So now we got the expansion away from the 20 EMA line, and now we're getting to the point where we are actually very overbought. Since we're very overbought, this is where I start to expect the trend to cool off, not just for a week or two, but a little bit longer, okay? This is where I expect the trend to collect more liquidity to prove that it has the momentum to continue to advance higher, overwhelming the supply, okay? Demand overwhelming the supply. So this is where we look at the trend here, we let it digest, we don't participate in any of this stuff, and right here, once we test the support line again, we print that demand candle right there. This is where you get confident again, okay? This is where you get confident again. So when you look at this demand candle right there, you can see there were some weaknesses, but if you just pay attention, I promise you, team, there's always these very clear signals smart money pulls out because they know they have to do their part. You see, this is the 50% retracement of that candle, and they didn't close any candles below the 50% retracement of the massive demand candle there. So smart money defended that move very well, and once you had that yellow momentum signal there, That was your very clear expansion away from the 20 EMA line to come in the upcoming sessions, and that's exactly what happens. So do you see how I use the 20 EMA line as a momentum gouge to figure out where the expansion is going to happen, and to also not get into any trades early on and waste my time? So the understanding is I expect the market to digest. Whenever we get a move, I expect the market to digest. All right? I let the market digest, and just at the right time, what I do is I wait for the right candles to come in, because, like I said, we have systemized our approach. We're not going to make it emotional based, where I have to decide what I'm going to do. If I have to decide what I'm going to do every day in the market, team, I'm gonna hate that, because every day I have a different emotion I got to deal with. I may have to deal with something with my life. I may my chemicals may be off that day because maybe I didn't get my usual breakfast, or maybe something happened last night to kind of mess up my emotions for tomorrow. So this is why we have a system to follow, so we don't base it on emotions. If we are in an uptrending market, I buy the demand zones. I focus on buying the demand zones and not trying to find a short entry at a level of resistance. I'm not going to try and short at at that level there. I'm not going to try and short there. My focus is to wait to see what's going to happen. Are we going to go back down inside of that prior demand zone, collect the liquidity, and then come back up? Or are we going to continue to digest here, not give it up, print a demand candle, and then that'll be the signal? Once we get that demand candle, that's all I care about. It tells me exactly what I need. So you buy at the demand zone, and letting profits run means you're expecting the resistance level to be broken and an expansion to take place. Now, if we take a look at the downtrend here, same thing. In a downtrending market, you're shorting at the supply zones, and the supply zone could be the 20 EMA line rejection. It could be an overhead resistance level that I showed you earlier. Whatever the supply zone is, whatever informed the supply zone is, you're shorting at the supplies, and you're expecting the support levels to be broken down because you're in a downtrending market. Makes it very, very simple, takes out the guesswork, takes out all the emotions, and it just puts me right where the smart money is, where the larger participation is, which in this case would be the uptrend. So yeah, very simple. That's how I use the 20 EMA line. I use it as a momentum gouge. When we come up to the 20 EMA and we fail to break down, it's a clear indication the trend is going to continue to go higher. Now, like I said, there are times where you get so overbought from the 200 SMA line, and you have to take that into consideration, that you're going to expect pullbacks to the home base of the 200 SMA line before we advance higher. Sometimes we may not exactly come back down to the 200 SMA line. However, we will get a beautiful 30% RSI buy signal test, where you're going to get in at that reversal with the RSI test there, and that is also a great buy opportunity. But that's how I use the 200 SMA line. You can see whenever we are in an uptrending market, we regain the 20 EMA line. This resumes the trend for another expansion away from the 20 EMA. Then we start to get away from it, and we start to digest, as you can see. We start to digest. We come back to the 20 EMA line, and then bulls start printing these. Now, this is a beautiful candle right here, team. If I saw that, I would 100% call this a bear trap candle. And I promise you, if I go back and I type it in on the Discord, a bear trap candle, it'll take us back to our conversation at that time. Whenever I see it, I call it out for the team. So what happened right there is you got that red breakdown candle, right? And you got the yellow momentum indicator, and this attracts a lot of short sellers. Now, it may not attract us because we don't want to short at the supply, right? Sorry, we don't want to short in an uptrending market. But let's say that other traders that don't have this understanding end up shorting at that level. What happened to them the next day is that the market gapped up. The market gapped up from 567 to 570, and it just shot up all the way to 573, closing above that prior day's high, and trapping all of the bears that shorted in the prior day, and then just advances up. So that's a beautiful bear trap candle right there, where it trapped the bears, and it's called trap and go. You trap and then you go, and that's exactly what happened. So if I saw that candle there, I would have said, hey team, we're going to get more green sessions in the upcoming days to come here, given that we're looking at this on the daily time frame, where each candle represents one day. So that's it, team. That's how I look at the 20 EMA line. That's how I use it as a momentum gouge, and it does such a beautiful job. It does a wonderful, wonderful job. So far, so good, team. How do you feel? So this is the current trend, by the way. This is the current trend, okay? You see how we have been grinding above the 20 EMA line every single time we come to the 20 EMA after the consolidation. Now, team, let me just emphasize on this, okay? What you're looking at, these small candles you're looking at, this is each day. This is each day. So you got day 1, day 2, day 3, day 4, day 5, day 6, day 7, day 8, day 9, day 10, day 11. You got 2 weeks of consolidation. 2 weeks of consolidation at that level. If you buy a call option on SPY 2 weeks out, you would be devastated, man. You would, by the time the move happens, you've already lost. So this is how crucial it is that you understand how the market moves and you do not waste your time trying to buy call options there. Where do you instead buy call options? When smart money enters. You see that bullish engulfing candle right there? That smart money candle right at the 20 EMA line? These are the days you buy call options because these are the days that pay. Okay, team? And yeah, that's, oh, remember we talked about the bear trap candle, team? Here's another bear trap candle. Look at that one right there too. That's another bear trap candle. You go down and what you do is, oh my God, this is the same candle we just saw earlier from a couple years ago. Oh my gosh. And here's another one right there as well. But yeah, you can see that that was a nice bear trap as well. They regained the 20 EMA line and just continued to advance right back above the 20 EMA. Now, like I said, team, you can get moves like that, right? You get the demand candle, and then you see that candle and that candle. Look, I understand it doesn't go up immediately, all right? But what I'm trying to tell you is that when you're able to predict or when you're able to see that the trend did not fall down, it tells you that, hey, just because they didn't go higher, it doesn't mean that, what I'm basically trying to say is when you see that happen, you're seeing the market continue to advance higher, just not in the S&P 500 overall picture. It may be those overwhelming stocks, it may be those, overwhelming and outperforming stocks that'll continue to go higher, or the other stocks that are getting rotation at that given time that'll perhaps continue to go higher. Let me give you an example, okay? The S&P 500 here seems like on Monday and Tuesday, it looks like it's going to get another green or another day or two of green sessions. And it may not happen exactly on tomorrow because the way that it looks like, they didn't obviously, like, we're not getting something where we're just advancing away from the 20 EMA line. We are somewhere right here, like away from the 20 EMA, but we're digesting well. The RSI is above 70%, which means at the smallest chances of normal market conditions, this is going to see major upside. So let's take a look at some of the stocks that can benefit from this setup, even though it doesn't exactly say that it's going to rip higher. So let's put that into use. Okay, so what stocks are getting rotation inflow? Let's go over it. Okay, so if we take a look at Everscore here, team, I can tell you with absolute confidence, this stock is going to see another green session heading into the upcoming week. So ES within the S&P 500 stocks is going to see more upside heading into the upcoming week here. Let's take a look at what else here. NEM has been going higher, and it's just in a continued uptrend, and I think they're probably going to work their way up towards 84, but I'm not going to tell you to trade that one. Let's take a look at Oracle. Now, team, why did Oracle come down? Why did Oracle come down after earnings? Because it was so damn overbought from the 20 EMA line and needed to digest to let the moving averages catch up. Okay, so this is why we took a short position on that day and made some nice profit for the team. We were just so absolutely overbought, and there are exceptions where I do short an uptrending market when we are so absolutely overbought from the 20 EMA line. Now let's take a look at Uber. How does Uber look, team? Uber is going to see another green candle heading into Monday and Tuesday session. Now, why do I believe that the overall market is going to advance higher? Well, because, like I said, because the S&P 500 is holding up and the RSI is above 70%. So as long as the trend continues to go higher, my focus is not to take advantage of this crappy setup there. All I care about is just knowing that with the slightest, or not with the slightest, you do want to have a, let's just say, knowing with a good understanding that the trend is still healthy, it's still up, and it can continue to advance higher. If that is the case, then I'm going to trade the overwhelming momentum stocks like this one that is getting ready to break that resistance level and get another expansion away from the 20 EMA line. Team, am I making sense here? Am I making sense? And are you understanding what I'm saying here by the trend continuing to go higher? Although the S&P 500 looks a bit overbought and it's given us a little bit of flash signals, the overall market tells us that it can basically there are stocks that are outperforming and that are showing that it's going to continue to go higher. So with the slightest chances that the S&P 500 is not going to sell off on Monday and Tuesday session, this means Uber is going to continue to advance. Okay, so this is what I mean. And during this time that Uber is going to continue to advance, there's another stock that's losing outflow. So let's go over the stocks that are losing outflow here. We got DXCM, we got Humana. So a lot of healthcare is starting to go down, as we can see. This one also, DG, Dollar General, you see this one was up so much, and this one is starting to pull back. So the consumer discretionary, retail stocks, consumer staples is starting to go down. DG, Lennar Corp. What stock is Lennar Corp? Let's see. This stock is, okay, home builder. Okay, so real estate, interesting. DRI, this looks like, okay, restaurant stock, so more consumer staples. But yeah, you're going to see stocks like MU that are very overbought, basically going on a small digestion or correction, waiting for the moving averages to catch up. And yeah, that's basically the point that I'm trying to make, okay, team? At the times that certain stocks pull back, other stocks are going to be leading. And as long as the trend continues to go higher and you're getting these stocks show up on your scanner, you're going to do really, really well. So Apple is showing up on the scanner, and it tells us that we're going to get another green session on Monday or Tuesday. This stock also CEG, Constellation Energy. This one looks like we're going to get more upside on Monday and Tuesday session. And yeah, that's how I look at my. Okay, I may have gone a little bit ahead, so let me pull back a little bit here and explain what I just did. Okay, team. So I showed you guys what the overall market trend was doing, using my understanding of the 20 EMA, the 200 SMA, the trend understanding and all that, right? And I look at the S&P 500 and QQQ as my leading indicators for the overall market. So if the S&P 500 is showing weakness, that means the overall market is going to show weakness. If the S&P 500 is declining, that means the overall market is going to be declining. Same with QQQ. If SPY and QQQ are going down, this means the overall market is going to experience a decline. All right? This is what I mean by I use them as a leading indicator. I use the S&P 500 and QQQ prices to understand what the overall market is doing. So if I see on this day, if I see that we rebounded right here from the 20 EMA line on QQQ and SPY, as we can see on the daily time frame, this means in the upcoming week, on Monday, Tuesday, Wednesday, Thursday, Friday, and so forth, I'm expecting the markets to be green in most of those sessions. All right, team, expanding higher. So if I expect that to happen, then what I'm going to do is I'm going to go over my S&P 500 stocks, and I'm also going to go over whatever scanner of a large list of 2,000, 3,000 list of stocks, or maybe 500 list of stocks that I have. For example, you can also go to social sentiment there, and you can look at other stocks that are showing up on the scanner. So this stock, Oklo, showed up on that day right here, showed up on that day right here, showed up on that day. And obviously, it's still showing up on my scanner, but I would not chase it because we're so overbought from the 20 EMA line. I would have gone in when it showed up on my scanner on those days. Okay, team? So that's what you do. You look at QQQ and SPY. You're like, oh, okay, they're showing that they're going to continue to go higher. Let me trade them. Let me look at what stocks are showing up on my scanner so that I can trade it with that given momentum and continuation of the market. So I go through my scanners and I look at what stocks are leading. And when I say what stocks are leading, what I'm really looking forward to is, let me show you a good setup, okay? I'm looking at what stocks are doing this, okay? What stocks are above their 200 SMA line, above their 20 EMA line, and they're printing a bullish engulfing to get ready for that 2 to 3 day expansion away from the 20 EMA line for the days to come. I'm looking for stocks that are in these areas so that I can take advantage of it for the team for those 2 upcoming days to trade. All right, team? This is why I go through my scanner and I look for those stocks. Like I said, I look for the stocks that are just right here, just getting ready to expand, and I trade those upcoming sessions with them. So this is why I look at my scanner every single day for about 10 minutes. And the way that I do it is when the market closes, right? I go on about my day, I go to the beach, I do whatever I have to do, and then in the evening when I'm back home, you let's say you have put your kids to bed, you are just getting ready to go to sleep, you're doing your usual stuff before you go to sleep. Here's what you do: you get on your computer for about 10 to 15 minutes, and you're gonna go down your list like this, okay? And here's what I have for my scanner. This scanner helps me find exactly what I'm looking for, which is outperforming stocks, okay? So Aaron said, what do you look for when you are setting up your scanner to find these stocks? This is what you look for, okay, team? This is what you need. You need symbol, which are the names of the stock. You need mark, okay? You need percentage change and net change. I use net change probably 1 to 2% of the time ever. I always use percentage change as the scanner, all right? So the reason why I use percentage change is because as soon as a stock outperforms right into the opening of that day, it shows up on my scanner and I can trade with it. Now, what I can also do is, sorry about that, I can let the stocks close out for that day, and at the end of the day, at the last 15 minutes of the market, before the market closes, I can come back to them, I can look at them and say, you know what? Oracle printed a bullish engulfing right here. So in the last 10 minutes here, before the market closed on Friday, here's what I do, okay, team? Right here is when I enter an Oracle call for next week. Not zero DTE, not weekly options, okay? You may buy shares for all I know. All I'm saying is you're going to take a bullish trade right there on Oracle, all right? A bullish swing trade right there. And the reason why you are entering is because you saw Oracle show up on your scanner, print a bullish engulfing after that consolidation zone, and it looks like they're going to head towards that level of resistance up ahead at 314 and even maybe 320 into Monday and Tuesday session. So far, so good, team? So what I do heading into Monday and Tuesday session is exactly that. I share this trade with the team, and we make bank on it. Absolutely as easy as that, okay, team? So the first strategy is you can buy a call option in the last 15 minutes of the market before it closes based on the stock on your scanner. The reason why you buy the call option in the last 15 minutes before it closes is because you don't want to buy a stock that printed a bullish engulfing within the first hour of the market and then it sells off all the way down into the last hour of the market. So the first strategy is you can perhaps enter into the second half of the market towards the closing session with a swing trade, expecting more upside to come heading into tomorrow's session. Or what you can do is you can let the stock close into Friday's session, and then over the weekend on your time, you look at your S&P 500 scanner based off of the percentage change, and this stock, Oracle, is the third one on the list, and it's up 4%. And it printed that bullish engulfing. So you're going to go, all right, this is good for Monday and Tuesday session. So into Monday's session, right into Monday's open, I'm going to buy an Oracle call option, and I'm going to target 314 first and then 319 if the momentum continues higher. So if I draw my level at 314 there, and I see bulls coming in to that level into Monday and Tuesday session, and they break above it, and they're holding well above it as a support, then I'm going to expect them to head towards my target at 319. All right, team? Absolutely as easy as that. That's how I look for these type of stocks on my scanner using the same high probability strategy that I explained to you earlier, using the 200 SMA, the 20 EMA, the consolidation concept, all of that good stuff, and going with the outperforming stocks and not choosing a stock that's in a downtrend. If you go ahead and say, oh, you know what, I'm gonna go ahead and buy BBBY on Monday session, well, here's what I can tell you. You're going to lose on this trade, because if you buy BBWI right here when it's at the bottom of its support level and it can go into a meltdown operation at its 30% RSI, you're going to suffer. You're going to be like, oh my God, why did I buy this stock? Why is this stock not going up with the overall market? Well, this is because the stock is in a downtrend. It's doing the opposite of the overall market. So do keep that in mind, okay, team? So you're not going to look at DG, okay? You're not going to look at DG and say, you know what, I'm going to buy the stock because it's down. Just because it's down here, it's red, it's cheap, I'm going to buy it. That's horrible. We do not want to do that. We want to buy stocks that are showing momentum, that are just going to continue to go up with the overwhelming momentum of the market, all right, team? So stocks that are showing up freshly on your scanner. They're not too overbought from the 20 EMA line. They're just starting their expansion. So you're not going to buy STX right there, okay? That's way too overbought. You're going to buy it either right here on that bullish engulfing candle, expecting these green sessions to come in, or you buy it right here when we get close to the 20 EMA line and we print that candle again. So you're going to buy it during their process when they're at the 20. So you get what I'm saying, right, team? You're not going to buy all the way up here. You're going to buy when we're back close to the 20 EMA line again. And then we go for another expansion. And that's how I use my, so if you guys remember, in the recent Sunday weekly watch list meeting, I shared that we would be seeing Microsoft continuing to advance higher. Now, let me see if I did post Microsoft here, okay, team? Give me one moment, please. Let's go to our weekly watch list to see if I posted Microsoft with the same understanding that I'm sharing here with the team. There are no secrets, team, no secrets. So this is the Sunday's meeting here. Looks like I didn't post it. I didn't post the chart itself, but I did talk about it on that video there. So on that Sunday session, we did talk about Microsoft. Now, what I wanna look at is to see if I did post the analysis. I'm 100% sure I did because I always do my research for the team. Here it is. So if you'll take a look at this is Rainbond's server here. Herself and I are in the server, and in the server we post our analysis and we get it ready for our team heading into the upcoming session. So you can see Microsoft, same understanding, rebounded well off of support. It regained its 20 EMA line, and as we can see, I said this was gonna go to 518 and then 517. Okay, I said that gap is at 517 is our target. Now, we had this options contract. We had the November 21st, 570 call. It was already up $120, and we said that we're expecting this to get more upside towards the 517 level. Let's take a look at Microsoft here heading into the end of this week. So we talked about that on Sunday, and now here we are a week later into the end of that week, and this is how it played out. You can see we enter right there, and it went towards our target very immediately the next day, touching that 517 before it sold off. And it came back up, and based on this setup here, team, what do you see on Microsoft? Another expansion to come, right? You're expecting another green or two sessions to come heading into Monday and Tuesday session. Very, very simple. You wait for them to show up on your scanner. You trade these beautiful setups where that massive demand is taking out that supply bar, and it's telling you this is a great setup. The volume is there, and I just love that it showed up on my scanner. I didn't have to go anywhere to search for these stocks. I didn't have to go down one by one all the stocks and find that stock. It just showed up on my scanner, and it's showing up among the best stock setups that I can choose whichever I want based on the type of strategies that I look for. And it's really beautiful. It's absolutely beautiful, and it's all happening based off of the percentage change finding, the percentage change scanner. Absolutely beautiful. It can't get more simple than that, team. And I really, really love it. And this is why over the last 2.5 years, you don't see any failed trades from me. You will see failed trades from me. Don't get me wrong. You're always going to see failed trades, but you barely have seen me buy these blow off the, what is it called? Falling knife stocks, these stocks that go down when the overall market is going up. You don't see that anymore. You see it, but just not often. I mean, you can look at my body's risky trade alerts. We have barely had any losing trades as far as I'm concerned. But yeah, that's the reason why is because these are the changes that I have finalized on my system that has really made me go with where the forefronts of institutional flow is. And I don't have to choose a stock like DG that's cheap and just continue to get falling knifed. I go exactly where the money is, and this is where the money is. All right, team, I think I'm going to conclude my session here. And I hope that the team got a great understanding from this, those of you that are watching. And I will also post that for our traders, for anybody on YouTube, so that you guys can rewatch it if you didn't see it earlier and learn all of this as well. Thank you so much for your time, team. I greatly appreciate it. I am more than happy to do this session, so do not feel bad for me. I really, really like to do these sessions because I want you guys to use the same understanding, the same strategies that are working for me, that have been working for me for years and years. And I hope that this does numbers on you guys as well. I hope you have a great rest of the day, great rest of Saturday, and thank you so much, team. I'm gonna go ahead and work my way up to the beach, have a good time with my lady. After making this session accessible to our team, posting it on YouTube, and keeping the learning curve going. Thank you so much for your time. Take care, everyone.